Welcome to The Explainer. Today, we're diving into what I like to call the tale of two landlords. Whether you're managing your very first duplex or you're overseeing a massive commercial real estate portfolio, there are basically two fundamentally different ways to track your finances, measure your success, and ultimately tell the financial story of your business. We're going to look really closely at these two lenses today: cash accounting and accrual accounting.
Okay, let's dive into this. Here is our roadmap for today. First, two ways to tell stories. Second, cash basis, immediate liquidity. Third, accrual basis, long-term profitability. Fourth, some real-world real estate examples. And finally, making the right choice.
All right, Section 1, two ways to tell stories. Let's get into it. So, to kick things off, we really need to understand that real estate accounting isn't just math. It's the actual financial story of your property portfolio. The method you choose completely dictates the story your numbers are telling you, your investors, and your lenders. Let me ask you this. If your bank account is full, does that mean your property is profitable? Well, it's kind of a trick question. This is what we call the illusion of cash flow. A full bank account right now might literally just mean a tenant prepaid their rent for the next 3 months. So you might feel incredibly rich today, but that cash balance could actually be masking a fundamentally failing property that's draining money on operations behind the scenes.
Let's compare them directly. On the left, we've got the cash basis, which simply mirrors your bank activity. And on the right, we have the accrual basis, which reflects the true economic reality of your business over time. Now, both of these methods are perfectly legitimate, for sure, but they answer completely different questions about the underlying health of your real estate empire. Moving on to Section 2, cash basis, immediate liquidity. Let's start with our first landlord's journey, the one who relies on the cash basis. Picture someone managing maybe a single unit or just a small handful of properties where things are kept fast-paced, highly intuitive, and incredibly simple. Under the cash basis method, you record transactions only when money physically changes hands. It's really that simple. You record rent only on the exact day the payment hits your bank account, and you record expenses only on the exact day you actually pay the bill.
As you might guess, there are major pros and cons here. This method is incredibly intuitive. It's fantastic for the DIY landlord because it gives you a direct, real-time view of your immediate liquidity. Plus, it offers some nice tax flexibility since you only pay taxes on the rent you actually collected. But listen closely here, because there is a massive downside. It can severely distort your long-term profitability. Think about it. If you have to replace, say, 3 water heaters in a single month, your profit and loss statement is going to look like an absolute disaster for that specific month, even if the property is actually performing exceptionally well over the year. Furthermore, because you aren't formally tracking them, this method completely hides any unpaid upcoming bills.
All right, Section 3, accrual basis, long-term profitability.
Now, let's shift gears completely and look at our second landlord. This is an operator who is scaling a massive empire, managing multiple properties and talking to big institutional lenders. This level of operation requires a much more methodical, sophisticated approach. The absolute anchor of this approach is something called the matching principle. With accrual accounting, you record income when it is earned, and you pair it with the exact expenses incurred to generate that income, regardless of when the payment actually happens. Doing this smooths out all those wild, unpredictable spikes in cash flow and gives you a really steady, accurate picture of your actual performance. The pros here are pretty substantial for a growing business. It shows your true long-term profitability. It's fully compliant with generally accepted accounting principles, or GAAP, which is literally what institutional lenders demand to see. It also forces you to track accounts receivable. That's what your tenants owe you, and accounts payable, what you owe your vendors. However, we have to talk about the cons. It definitely requires a much higher administrative effort. And crucially, it introduces this thing called a cash gap risk. This is a really dangerous scenario, where your financial books are showing that you are highly profitable, but your actual bank account is currently sitting on empty, just because those profits haven't actually been collected yet.
And that brings us to this number right here, 20 units. This is a critical threshold. According to industry data, right around the 20-unit mark is where accounting complexity absolutely leaps. At this size, the sheer volume of transactions, lease variations, and maintenance invoices completely outpaces what a simple spreadsheet or a basic cash basis system can handle reliably. This is the exact point where shifting to an automated accrual system becomes almost mandatory if you want to avoid compounding reconciliation errors.
Okay, Section 4, real-world real estate examples.
We understand the theory now, so let's put these two lenses into a direct, head-to-head stress test. We're going to see how the exact same real-world events look entirely different depending on the accounting method you choose. Let's start with a classic landlord headache. What happens when rent is late? This brilliantly illustrates the core difference. Imagine your tenant's rent is due in December, but they don't actually get around to paying it until January 2nd. On the cash basis side, it records that money purely as January income, just because that's when it finally hit the bank. But with the accrual basis, it records it as December income. Why? Because December is the month the property was actually occupied, and the revenue was genuinely earned. Accrual perfectly matches the income to the correct operational month. It just makes sense, right?
Let's move to a second scenario and see how this builds when we look at expenses. Say a vendor completes a repair on your property in April, but they don't actually invoice you until later, and you finally pay the bill in May. The cash method throws that expense straight into May, but the accrual method, it tracks the obligation exactly when the service was performed. It records the expense in April via accounts payable, which ensures that April's financial costs accurately reflect April's actual operational reality.
Okay, here is one more stress test. Prepayments. Let's say you prepay $1,200 upfront for a full year's worth of a tenant background check tool. The cash basis takes a massive $1,200 hit on day one, which makes that single month look terribly unprofitable. The accrual basis, however, treats that upfront cost as a prepaid asset and simply amortizes a smooth $100 expense over the next 12 months. It creates a much smoother and, quite frankly, much more accurate financial picture of your ongoing costs.
Finally, Section 5, making the right choice.
Now that we've seen how drastically different these stories can be, let's get into a clear, actionable framework so you can make the right choice for your specific business scale. To summarize the evolutionary arc of a real estate investor, if you're a DIY or small landlord focused mostly on immediate liquidity and simplicity, the cash basis serves you really well. But as you evolve into managing multi-property portfolios where you desperately need to track long-term profitability, secure institutional financing with GAAP compliance, and rigorously track accounts receivable and payable, well, the accrual basis becomes the clear winner. But hey, sometimes the choice isn't even up to you. Under the 2025 IRS rules, the small business exception generally ends when a business hits $31 million in average annual gross receipts over the prior 3 years. If your real estate business crosses that $31 million threshold, you are legally forced to switch to accrual accounting for tax compliance purposes. No way around it. So if you're growing and you realize it's finally time to make the leap from cash to accrual, there's a strict process you really must follow. First, consult a qualified CPA. Seriously, do not do this alone. You'll need to carefully adjust your opening balances to reflect unpaid rent and outstanding invoices so absolutely nothing gets double counted. Then you'll update your software settings and document the entire change thoroughly for the IRS. Just a quick warning here, changing your method mid-year requires extreme care, and pretty much all experts recommend aligning the transition with the start of a brand new fiscal year. But the good news, technology has totally caught up. Modern property management platforms like Tenant Cloud, Buildium, and AppFolio can actually run both methods simultaneously. It's a real game changer. If you just record your transactions with enough detail, like logging the invoice date, the service date, and the payment date, the software can generate a cash flow statement for your immediate liquidity needs and an accrual P&L for your long-term performance tracking. You get the best of both worlds. So the crucial point we're driving at is perfectly captured in this quote from Madras Accountancy. Choose a method that fits both operational needs and tax requirements, rather than defaulting into one simply because it was selected at startup and never revisited. Your accounting method absolutely must evolve right alongside your real estate empire. Ultimately, the goal here isn't just to check a box for the IRS or keep your bookkeeper happy. The real goal is to align your method with how you actually run your business. You want to turn raw financial data into a strategic weapon that helps you forecast, budget, and really fuel the long-term growth of your portfolio. I'll leave you with this final, provocative thought. Go take a look at your current financial reports. Which accounting lens is telling the true story of your real estate business today? Are you seeing the full, accurate picture, or just the cash sitting in the bank? It might be time to evaluate your software setup and ensure your numbers are actually working for you. Thanks for joining me on this explainer, and keep building that empire.